Managing your inventory in any business is complex. When you throw e-commerce, seasonality, cash flow issues, it becomes almost impossible. Whether you're selling Shopify, Amazon, multi-channel, omni-channel, whatever it is, it becomes really difficult to manage inventory. So just a couple of points that are worth being aware of, which might make your lives a little bit easier. First of all, it is worth trying to do inventory forecasting out what your inventory purchases will look like in the near future based on what your inventory purchases were like in the past, taking into account your ad campaigns and what you anticipate to sell will look like in the near future. You could also, in addition to your own proprietary data, look into more general macro trends. What is a specific season? Are you looking at the Black Friday, Cyber Monday holiday season? Are you looking at a drier season? Perhaps your business in particular has a different sales cycle than most businesses. So you have an evergreen kind of inventory cycle. Whatever it is, it's worth building your forecasting into your system in order to know how many units to order and when. Second point is holding the proper amounts of inventory, right? On the one hand, you don't want to be holding inventory which is too low, because then you're going to end up having stockouts and your hard-won customers will just end up moving on to your competitors. On the other hand, if you're holding too much inventory, you're going to have significant carry costs, shrinkage. You're going to end up having write-down of inventory because inventory in the future generally is worth less than it is today, unless you're some kind of a real evergreen brand like IKEA, but you'll be holding precious cash within the inventory instead of using it for other items. So you want to get to what's called a good inventory turnover, which means you're turning over your inventory well, not too high that you lose control of it, but not too low so you'll have inventory just sitting in your warehouse. Depending on your area and on the category of your business, the inventory turnover metrics can change, but you generally want to be at least over 3 and up to 9, 10, 11, depending on your line of business. If you can really optimize it and get up to 12 and have net terms of 30, then you can even have a negative cash conversion cycle. That's for the more advanced businesses, but in general, it is worth being on top of your inventory and not holding it for too long. And that can be done by selling off worse selling items or bundling them with better items, perhaps changing payment terms, sales, etc., trying to cycle out older inventory in order to make sure you're not holding it for too long. Because in most cases, unless you're selling wine, it's not going to improve with age. It's also worth keeping in mind what your lead time looks like and how long it takes for the inventory to actually hit your warehouse from when you've ordered it from your suppliers, and how long it takes from when it leaves your warehouse until it gets to your customer's doorstep. So you have to make sure you have enough, taking that lead time into account. When you have enough in your warehouse today, you might not have enough if you have X amount of orders, but lead time just doesn't match. And then you want to also have some kind of safety stock, which is like an extra surplus of a certain amount, again, depending on your specific category and line of business, to make sure that even above your lead time, you have a certain, let's say 10% of extra stock, a small amount of safety stock to make sure that you have enough just in case. And one last point is being on top of your COGS accounting and on top of your units per warehouse. It is really important to know how to allocate your COGS versus your inventory, meaning if you're doing accrual accounting and sales-based inventory accounting, when you buy the inventory, you're not recognizing an expense in your books, right? It's like buying a building. You don't recognize an expense. You recognize an asset because you have this building or this inventory for X amount of time, and you depreciate it, or you recognize an expense over time, or an inventory when the inventory is actually sold. So having good COGS-based accounting is crucial for any business, especially in e-commerce, when you're buying various items over time and the prices change and there's inflation and there's different components that change and there are tariffs that hit a certain amount and not other items. Knowing how much you spent on each item is crucial to recognize when you're actually selling those items in order to figure out pricing and profitability. So being on top of your COGS accounting is crucial. And knowing how many units you also have within each warehouse is also really important, kind of touching back on the reorder points and the safety stock points to make sure that if you have one warehouse which is servicing a specific area and the other, let's say, East Coast versus West Coast, knowing you have enough units per warehouse and not just enough units generally is a really important point to be on top of when it comes to managing your inventory. That's it for today.